Hello everyone, my name is Nishant Singh. I head the IR function at Narayana Hrudalaya. I welcome you all to the Q2 FY25 earnings call for the company. To discuss our performance and address all your queries today, we also have with us Mr. Viren Shetty, our Vice Chairman, Dr. Emmanuel Rupert, our CEO and MD, Mrs. Sandhya Jayaraman, our Group CFO, Mr. Venkatesh, our Group CEO, Dr. Anish Shetty, MD of our Cayman business, Mr. Ravi Vishwanath, CEO of NHIC, and Vivek Agarwal, Senior Manager in the IR function. As usual, before we proceed with this call, we would like to remind everyone that the call is being recorded and the transcript of the same shall be made available on our website as well as on the stock exchange later. I would also like to remind you that everything that is being said on this call that reflects any outlook for the future or which can be construed as a forward-looking statement must be viewed in conjunction with the uncertainties and the risks that they face. With that now, we would like to start the Q&A session straight away. I request everyone to now use the raise hand features to start posing their questions. Here's them, please go.
Hello.
Yeah,
Hello.
please go ahead.
Hi. Good afternoon, everyone. My first question is if you can talk about how the new unit in Cayman is ramping up, whether it was a soft launch, it's a full-scale launch for you, and how do you see cost normalizing for this facility?
Hello. Hi, Damayanti. Thank you for your question. This is Anish here. So the hospital has been, the outpatient facility of the hospital has been commissioned about a week ago. So in the quarter which results you are seeing that is Q2, the facility was not commissioned. We've started outpatient services, that is doctor consultations and limited diagnostics now. We've been approved to do that. We hope to get approval to start the entire hospital in about approximately, we hope in the next 4 weeks or so. And that's when we'll start. Having said that, to the cost section of your question, in Q2, in the last month of Q2, we think we have incurred approximately about 65 to 70% of the total cost for that new hospital. And in October, which is the month just gone by, that's closer to about 75-80%. So we are currently incurring most of the costs, and the revenue ramp up has gradually started, and we'll see that more aggressively once the entire hospital is commissioned.
Okay. So in next 4 weeks, you mentioned you will be seeing full-scale offering of services, and then the footfalls, etc., should be much better compared to
in the next 4 weeks we expect the whole hospital to be commissioned and ready, and then it will take, it's a new building, so it will take a couple of weeks for people to start flowing in. But yes, you are right, we expect to be all good to go in approximately 4 weeks is our hope.
Okay. And in terms of cost, as you mentioned, already 75 to 80% of cost are already in the books. So going ahead, we assume most of the cost will be in line with like what kind of pickup you see on the business side, because I understand.
You are right.
Okay.
Yeah, that's correct. Yeah.
Okay. My second question is on your capex projection for FY25. So I understand you have earmarked around 9 billion of capex towards greenfield and inorganic growth opportunities. And
Sorry, we're not able to listen to you. We can't hear you.
Damayanti, can you hear us?
Maybe we can move on to the next
one.
Okay, we'll move on to the next one. Damayanti can join back in the queue.
Yeah, please go ahead.
Prithvi, can you go ahead?
The first question is again on Cayman. Given that the hospital is now almost ready to commission, do you have some kind of guidance, say over next few quarters, how do you expect the ramp up to happen, and how do we see margin shaping up?
Yeah. Hi, Prithvi. So if you recall in the previous, in last quarter's call, what we had said is that once the hospital commission, is fully started, we expect margin dilution to last for approximately 6 to 8 weeks. Having said that, now that we are very close to the hospital being fully commissioned and we've actually commissioned the outpatient services, we're happy to see that our cost control is more in line with is more on the positive trajectory. So we'd like to, change our estimates from the 6 to 8 weeks and make it closer to about 6 to 8 quarters, and change it to about 4 to 5 quarters is when we expect some margin dilution. So we're more optimistic on the cost front. Now that we have commissioned the outpatient services, we are seeing a lot of interest. Everybody is very, very impressed with the hospital, and the reviews have been fantastic. But it's just the outpatient, which is a limited service. We hope to continue to see this positive response in about 4 weeks or so when we commission the whole hospital.
So when you say margin dilution for 4 to 5 quarters, you mean the margins will be less than 40% for 4 quarters. Is that the point?
No. So if you recollect, just prior to commissioning the hospital, when we were, when we did not have any of the costs on the books, our margin was higher than the number you mentioned. And at that time, we had said that once the hospital is commissioned and once all costs are in line, we expect to take 6 to 8 quarters for the margin to come back to where we, a steady base. We are now more comfortable changing that 6 to 8 quarters to about 4 to 5 quarters. So it's not that it will, it'll be the worst will be in the first quarter, and then it will hopefully taper away as we move closer to the end of the year.
Fine, that's clear, Anish. Second, on the India business, can you give the breakup of the new hospital's revenue and margins in this quarter?
Yeah, the new hospital cluster has done pretty well in this quarter. It's given a very strong revenue growth, around 13% year on year, with the revenue crossing around 130 crore for this quarter, with an EBITDA of around 11%. The Mumbai has also shown positive EBITDA of around 1.5%, and Gurugram at a high single digit EBITDA, and expected to grow more by the Q4. So overall, the new hospital cluster has done well in this quarter.
So what explains this traction in the new hospitals? Is it more of any seasonal factor, or you are saying it's structurally going higher?
Would have happened, just that it took a long time for that to occur. We are on track to achieving normalized performance for all the hospitals. The Mumbai hospital, being a children's hospital, that will take much longer given its very specific focus. But the Gurgaon and Dharamshila hospitals will go on the normal trajectory.
Final question on the CapEx. Did you finalize the numbers on the number of beds that will be added in Bangalore and Calcutta?
Yeah, we are still working with the architects, the number of beds for HSR. Yeah, just go ahead. So, I mean, we know that the majority of our investments are now planned around Calcutta and Bangalore and some other geographies where we have our strong presence. We've already committed projects which include greenfield in Kolkata and Bangalore, totaling to around 700 beds, and a brownfield in Raipur with around 150 beds. This will come up in the next 3 to 3.5 years' time. We are also working closely on trying to close around 1 to 2 more greenfield projects. But all in all, it would be adding around close to 1,500 beds in the next 4 years from now, with no material delays expected on the projects. And obviously, the large portion of it will come in the third and the fourth year.
Thanks, that's all from my side.
Thank you, Prithvi. Nitan, can we have your question, please?
Congratulations to the management on a good set of numbers. My first question would be regarding the Rajarhat facility in Kolkata. It is was supposed to get approvals by October 2025 and supposed to start the constructions are supposed to commence in Q3 FY25. So, any updates on it?
So, the applications have all been done. The process approvals are in progress. We expect all the approvals to be sought by the next 3 to 4 months' time before we start the groundbreaking there.
Okay, 3 to 4.
Yes.
The second question is regarding the Cayman facility. It's going to be commissioned in 50 beds, I suppose, right? The new facility, which is the outpatient daycare facility.
Yeah, that is correct. But again, given the the way the facility is configured and the focus on daycare and emergency and services that would not constitute a bed as the unit of revenue, just be cautious about extrapolating a bed-driven revenue number with the existing facility.
All right. And one last question is regarding Cayman as well. So the number of outpatients have been declined on a year-on-year basis, and as well as AROP has been declined 6.6% quarter-on-quarter, as well as discharges and OP volumes are also a bit down on a YOY basis. So is there any particular reason of seasonality or any particular, can you share some light on it?
Not particularly, but on an overall basis, we weren't too happy with the quarter. There were few factors that led to the slowdown. All across, it's uniform. It's not any particular specialty or particular category. Everybody, the whole team has been focused for the past few weeks on commissioning the new hospital. It's a lot of time to fulfill all the compliance-related obligations. We had, a couple of hurricanes that led to about 7 to 10 days of unproductive work. Just a general a slow quarter, but we're happy and comfortable that in the month of October things are back to a very positive trajectory, and we think that that's behind us now.
All right, that answers all my questions. Thank you for it.
Thanks, Nidant. Abhishek, can we have your question, please?
Hi, am I audible?
Yeah.
Yeah, thank you for taking my question. So, my question is regarding your liquidity levels. Right now, if you look at your balance sheet, you have a lot of liquidity tied up in Cayman. That is after considering the outlay that has happened for expansion in Cayman. So, any plan to put that liquidity to work? Because I understand getting that money to India, there might be taxes which we'll have to pay. So right now we are using it to pay dividends, but how do we get that money to work? Because it's a large sum of money, and I'm assuming you would not want to do further outflow capex in Cayman, right?
Yeah, so Abhishek, you raised two good points. The first is you are right that the majority of our capital outlay in Cayman is mostly complete. I mean, we have a last few a little bit of expenditure for the new hospital post commissioning, but with the new Cayman Bay hospital, we're done with any significant capital outlay in that market. So that is correct. The liquidity, I would just, although there is a cash balance, it is also significantly netted off against our outstanding debt, which we essentially borrowed to finance the new hospital. So just looking at only the cash reserves in that market, it should be offset against the outstanding debt there to see on a net cash basis how much we have. There is some surplus even on a net cash basis, and we are obviously using that whenever we have a suitable opportunity. As we've previously said, we continue to be on the lookout for opportunities in the region and elsewhere as well. And all options are on the table, whether it's to repatriate it to India if there's a need and a suitable opportunity, or in some other market. We continue to consider all of them from time to time.
Understood. Thank you so much. My second question is regarding your growth. So now I understand that it's a long gestation period projects of the hospital industry where bulk of your capex is front loaded and it takes 3 years to make the hospital and another year and a half to break even. So why is it that we are not looking at acquisition as an opportunity? Because you already get a built-up hospital and potentially broke even. So we save a lot of time, no? So why this decision to go greenfield?
Abhishek, it's not that we aren't looking. Nishant leads a fairly busy M&A practice looking at all the acquisitions. It's just that you understand as well as we do on the outsized valuations of some of the private equity-backed assets that are out there. So group hospitals do not make a lot of sense for us. One is that it's fully priced in, and there isn't too much delta available for us to be able to make a lot of sense of the acquisition. The last thing that we would look at then would be single hospitals, individual hospitals. Those are not as easy to find. The ones that are for sale are very badly built, or they're not in strategic areas of focus for us, or they may have a lot of issues with the promoter, or they'll be really old rented out assets. So we spent since 2016 trying to pursue multiple opportunities, both asset light, acquisitions, all of that. It's just that out of absolute compulsion, in the absence of finding anything else to do, we have gone for the greenfield. But still, we are pursuing few acquisitions, things that are still in discussion both here as well as overseas. We are looking at certain O&Ms and asset-light opportunities. It's just that these are the ones that we were able to finalize in a very long time frame, absent anything else happening. We haven't turned our back on the availability of the opportunities out there and constantly evaluating. But when these things come, we do take it up. For example, Sparsh had one hospital that we acquired. Similarly, in Cayman, there was an ENT practice that we acquired. So whenever these things come up, we do. But you're right. It does seem like all the things we're presenting to you are greenfield and these have a very long gestation period. What are we going to do for growth in the meantime? There remains sufficient headroom in the existing business to deliver on moderate levels of growth. And these greenfields will deliver a much larger footprint for us 3 years from now. But in the meantime, we'll look for things that those haven't materialized in the price band that we wanted.
Thank you for such a great explanation. That was very helpful. One last question. Anything we are looking at tier 2, tier 3 cities? Because I'm assuming
Yes.
Okay.
Yes. But with all the same problems, which is asset price, almost the same as in a tier 1 city with a much lower earning profile. So there are a few distress acquisitions we found in our core geographies, which is in West Bengal and Karnataka. We'll be pursuing those. But so far, the ones that we've been able to finalize and announce happen to be the ones that we had to buy the land and get going. But there are opportunities and we are in active pursuit of all of them.
Okay. Thank you so much. I'll get back to the queue.
Thanks, Abhishek.
Thanks, Abhishek. Yeah, Riddhi, can you please pose the question?
Yes. So my first question was, despite the growing demand for healthcare services in India and the relatively low debt equity ratios of established hospitals like Narayana, why are there not more new hospitals being established across the country? Like, I'm talking from an industry point of view and not just related to Narayana.
That would be a combination of things. If you're just asking for broad level industry reasons why aren't more hospitals coming up, for the same reason that Abhishek had brought up. It's very expensive. It takes a long time. The return on capital oftentimes is less than the cost of capital for a lot of these new hospitals coming. The huge reliance on payers who aren't very dependable on paying on time. Very poor patients in most parts of the country where there is greatest demand. So greatest demand exists in the very small towns, but over there, there are almost no organized pay. It's paying out of pocket or the government is a payer there. Lack of doctors, extreme lack of super specialists, them wanting to work in large metro towns and not so much in the small towns. So there's this oversupply in large towns and very undersupply in the smaller towns.
The organized players have all announced significant bed additions over the next 3 years, including us.
So all of us are, I would say, expanding to the best of our capabilities, keeping our the debt equity ratios in mind, making sure we don't overstretch and over leverage ourselves. And all the players are in a pretty, I would say by historic standards, aggressive capex expansion. But yes, we are nowhere close to, say, any of the quick commerce companies or the cement companies or road and railway companies in terms of how much capex they are doing and how much any project they're announcing. Our business is not one that has any barriers and any sort of inbuilt protections. It is highly competitive, highly consumer oriented, and it's one in which it's very, very difficult. We have the same upfront investments and long payback periods as infrastructure, with none of the benefits that infrastructure projects get, which is extremely long-term lending, as well as a guarantee that when you put up a highway, no one builds a highway right next to you.
Okay. Hello?
Yeah, go ahead.
Yeah. So I also wanted clarity on the capex that you're currently coming up with respect to Kolkata as well as with respect to Bangalore. Like, yeah.
We have spent about 530 crores in H1, of which 320 crores is in India and balance is in Cayman. Out of this 320 crores, 160 crore was for the land we bought in Bangalore, and the rest was regular capex, which we spent for biomedical, etc. And some amount of small brownfield capex we have incurred in Kolkata. So this is what we've spent so far. Once we get the approvals for building, then the Bangalore and the Kolkata build will start. And therefore, while we've put in some money there in terms of how much we will spend, some of it may get pushed out by a quarter or so. In addition, we're also looking at a few more greenfield land opportunities. So depending on how we time the deals and conversion as well, some of those costs will also get incurred.
Okay. So earlier in one of the con calls, Narayana had mentioned that 1,000 odd beds were going to be built in Kolkata, and then in last quarter they said, I mean, you all said that it will be around 600 beds in Rajarhat. So I'm just a little confused whether it's 1,000 or 600 odd beds which are going to come up in Kolkata.
That is correct. The intent is to add 1,000 beds in Kolkata, but it will go live in 2 phases. So
Okay.
for the first phase which we are building is what we have factored right now. Then once those get completely occupied, then we'll go for the second phase. The 1,000 beds is coming from our longer term demand view, as well as the ability of that infrastructure to be able to accommodate that capacity. So from that perspective, that outlook has been given.
So in first phase it will be 350 odd beds, and then later on
Yes.
the remaining which you plan to add, right?
Yes, yes.
Okay. And secondly, you already have a land in as an annex to the hospital in Bangalore, right?
Hello.
Yes.
Yes.
Correct. So
Yes.
there also in last con call, it was said that the capex that you plan to do is around 500 crores. So that is only with respect to now constructing the building, right? There is no land cost that will be there.
I think the 500 crores estimate was given for the greenfield opportunity that we are doing in Bangalore.
Okay.
And there is a land available next to the our current hospital, and we will be building in that. But depending on we will be prioritizing on the cash flows and the opportunities that we keep that we are attempting from time to time. So the confirmed builds which have commenced are the ones that Venkatesh called out in his part of the answer.
Okay, so any idea on the number of beds that you plan to build for the annex that you already have, the land which you already have?
We won't be building it at this point in time. The things that we've announced, the 1,500 beds between Bangalore, Calcutta, and Raipur, will be all the new projects. The annex building we had announced earlier, but then we decided to push it in favor of pursuing something much closer to the city because there are sufficient beds in our flagship health city. We have a desperate need to do that right now.
Okay, so this 500 is for the new greenfield project that you're saying, 500 crores capex.
In Bangalore, yes, the one that we've already announced.
This is both land and beds costing.
Correct.
Okay, thank you.
Thanks to the Parikshit. Please go ahead.
Hi, thank you for the opportunity. So first part I want to understand is that the India business, it seems like the bulk of the growth that you have gotten is because of the IP ARPP growth, which seems to be about 14.5% nearly this quarter. I'm just wondering why it's such a high number in this in the ARPP for inpatients.
Sure. See, actually, if you see the India growth, there is a mix which is playing out. And we have called this out. Our international mix has significantly declined, and we have made it up with domestic business. Historically, the domestic ARPP has always been higher when compared to international ARPP. So some of that has played in terms of the average ARPP that has come through. Second also is some of the advanced procedures that we do. There was a healthy growth in these complex procedures which come at higher realization. So that has also helped in the growth of the revenue per patient. So in all, the ARPP has shown a healthy year-on-year and quarter-on-quarter growth.
Yeah, adding to that, even the peripherals, including the eastern and the western part of the country, there has been a substantial moderation of certain poor payer profiles. Obviously, because of that, shifting them into more of preferred payers, the benefit is also shown in ARPP and margins. That is also an added contributor to increase in the ARPP for this quarter.
Thank you. But can I just request you to repeat the first point again, Sandhya, because I didn't understand that we usually have better ARPPs in India versus abroad, and then I couldn't follow why that would increase the ARPP in India today.
I'll explain that. Our international patients primarily come from Bangladesh. We had taken a call that we would not charge people coming from abroad a different rate than what we charge domestic patients. The people who come from Bangladesh to our hospital tend to be poorer than the average patient that we get from patients in Bangalore. The ones who can afford more end up going to the hospitals that charge more. And so the average patient realization goes up when we refocus on domestic patients.
Got it. So that means that our the footfall that we were getting from Bangladesh has been impacted and continues to be impacted because of whatever is happening there. Is that a fair statement?
Correct.
And there are multiple volatilities associated with a business in India depending too much on foreign patient travel. In the past, it was the war in Afghanistan or some visa issues, or you may have trouble with some countries in the neighborhood. So it's not something that we want to be too reliant on going forward. And so we have given guidance, and I'll continue to do so, to say that the international business is one number that I expect to go to zero over the next 10 years. So we're not spending too much time and energy focused on attracting more patients from international geographies and focused instead entirely within a domestic radius, highest priority within the 15 kilometers of all our hospitals, and larger circles around central India and eastern India.
Got it. So the flip side of this coin is that for the fourth quarter now, we have our inpatient footfall has either been flat or slightly negative on a year-on-year basis. So is the story here the same, that because we have to replace the footfall you're getting from Bangladesh or from abroad, and we are replacing them with domestic customers, and that is taking us some time? Is that the story?
I think we are replacing with higher paying customers. Whether it is, for example, 1.5 scheme patients equal to 1 cash patient. That is how the mix works. So when we are able to attract more cash paying customers, it may look like you are seeing a lesser than regular growth on the footfall. So I think that's why it is coming out like that. We are replacing reasonably well.
So value-wise, the replacements are far superior to what it was earlier. But the degrowth through these international patients have been to the extent of 19%, but the domestic has grown by around 13.5% to 14%. But that 14% has contributed to a higher value than the degrowth on the international patients to the extent of 19%. So that's how this equation is worked out.
Perfect. The other thing you mentioned is that the mix of the complex procedure is growing. Is this a one-time or a slightly more arbitrary change in mix, or is this a mix that we should continue to expect going forward?
Dr. Rupert will answer.
Yeah, this mix we should continue to expect that. There will be some month-on-month changes, but considering the way we are focusing and some of our flagships are into very high-end tertiary and quaternary work, we will continue to see this trend.
For example, our flagship cardiac center did a record number of TAVI procedures. TAVI is a very advanced cardiac implant, and same of the cost.
Yeah, so and also the kind of procedures that we are doing, we are able to very high-end cardiac work. Not only that, but oncology, robotic works have been going up. We did the highest number of robotic cardiac surgery in one quarter. We did around 113 robotic cardiac surgery in one quarter. And there are some hospitals which have done 500, 600 over 7-8 years period. So this is the volume of work that happens here. And we will continue to see this kind of high-end work going up in this one. And the good thing is most of our centers are also picking up on the complexities of the work. And we will see the uniformity of the complex work across most of our centers.
Got it. So there is a pretty large difference between the ARPP growth in the IP segment versus the OP segment. Would I then be correct to assume that these complex procedures are mostly inpatient procedures and not outpatient ones?
Yeah, most of the complex procedures are inpatient, but we are also reducing the length of stays of this. As the team is getting better and better, we are constantly working on that to reduce the length of stays of these procedures.
Got it. So this 14.5% in ARPP growth for inpatients, would it be directionally possible to split this between normal inflationary increase versus complexity increase versus better paymasters, paying customers increase? Would that be possible to directionally split that growth?
Our typical price increase is low single digits, 4-5% every year. So anything beyond that is all efficiency driven. Efficiency, realization, higher order procedures, better payer mix. So everything is driven by that. Our price increase typically compensates for inflation partially, and partially we offset inflation through efficiency.
Got it. Okay, fair enough. So coming to Caymans, I think you gave an explanation. You gave an explanation that the team has been focused on setting up the new hospital. They've been slightly more distracted, but this is now the second quarter where there has been negative footfall in terms of IP, right? So again, I would ask, is there anything structurally happening in the Caymans market which is leading to a fall in market share in that space, or is this the hurricane stuff and the distraction and basically that's it, nothing else?
No, there's no structural change. In fact, we continue to be positive about the early traction with the new hospital and all the new services we are commissioning. I think it gives a more holistic picture in a small unit with relatively low transaction volumes to focus on not one metric, but multiple metrics to triangulate on a picture to get a better sense of the performance of the business. So while just focusing on one metric can lead to alarm, I would just request to look at more of a holistic picture and the directionality over several quarters at a time.
All right. Thank you. Thanks a lot.
Thanks, Parishit. Yes, Bino, please shoot a question.
Hi, good afternoon to all. Most questions answered, but just carrying on from the previous question, what is the latest situation about these Bangladesh patients? Has the travel and other issues sorted out, or is it still impacted?
No, the situation in Bangladesh, it continues to suffer. The visa restrictions are still in its minimal. Only the critical patients are allowed entry into the country. It would definitely take a long period of time for the situation to normalize. We don't even know and have no clarity in terms of the timeline by when it is going to get normalized. But as of now, the situation still remains grim in terms of footfalls from Bangladesh to our hospitals here.
Got it. And just follow up one question on Cayman. So this quarter, for whatever reason, the inpatient numbers and the revenue per patient was lower. You just mentioned that it's just a quarterly phenomenon. So are we expecting growth to pick up and continue next quarter onwards?
Yeah, absolutely. In fact, we've already seen that in the first month of Q3, which is October. And there will be two reasons for that. One is just a return to normalcy, and also at least by December of this the last month of the quarter, we hope to have the early signs of the new hospital with outpatient work and inpatient work kicking in. So we have every reason to believe that will be back to normal and a little better.
Yeah, but the new hospital, of course, is a new hospital, but just the inpatient volumes and revenue from the old hospital, would that separately continue to grow or get back to growth back in this quarter?
Yeah, as I said, so in October, we did not commission, we had no activities in the new hospital. It started only in November. And even in November, only the outpatient work. And in October, we've already seen a return back to our old trajectory for the old hospital as well.
Got it. Thank you.
Yes, Rishit, can you please have a question?
Yes, sir. Congratulations, team, for the decent set of numbers. Sir, I wanted an update on the insurance plan, Aditi. We did our pilot in Mysore. Now we are expecting expansion in Bangalore. So, what's the ground attraction and what's the response at the pilot level?
Hi, Rishit. This is Ravi Vishwanath. Yeah, I mean, as you rightly said, we started with our pilot in Mysore. And the focus, of course, is in making sure that our process and everything was good. We were sufficiently encouraged by the results that we actually preponed our entry into Bangalore and launched in Bangalore as well towards the end of the quarter. And right now, our focus is on building our distribution. We've done about 1.2 million rupees of premium GWP since we started. But obviously, we're building a retail business. And a direct retail business, and that takes time to scale up. And so our focus right now is on scaling it up and building various distribution, support and channels for this. But the results have been encouraging, and we're looking to accelerate growth in the coming quarters.
Okay, that's great, sir. My second question would be on the overall business with Cayman coming in from this quarter and a lot of capex coming in already. What type of growth number do we see for this financial year as well as the next financial year? What's the internal growth target for us?
I mean, we don't normally give out guidance on the growth numbers. We're just trying to maintain a healthy pace of growth, keeping in mind that we're not adding any new beds and we're doing a lot of internal reoptimizations, and with the focus on a very healthy EBITDA and focus on improving the realizations per patient, reducing the A loss. So the trajectory that we've been able to keep so far, we'll continue to try and maintain.
Yeah,
Understood.
we have a long way to go for utilizing our efficiencies, transformation projects, using technology for improving the efficiencies. We've always demonstrated this growth in the last few years, and we will continue to do that.
Understood, sir. And sir, one accounting question that we have been taking advantage at the consolidated. Hello, I'm audible?
Yeah, you are audible. Yes.
At the consolidated level, we are getting a tax advantage due to the Cayman facility. Now the new facility coming in, do we see any further tax advantage coming in at the consolidated level, or we'll stay in that bracket of 14 to 17%?
See, Cayman comes at zero tax and India comes at India taxation rate. So if the share of profit of Cayman in the overall mix goes up, the ETR goes down. So that's the logic. But what we are seeing is that India also has been doing quite well in terms of India's performance itself, and Cayman will come back up after the new facilities commence. So we would like to maintain the outlook on the tax rate as it is going currently.
Okay, ma'am. All the best, team, for the coming year. Thank you.
Yeah, Avnish, can we have a question, please?
Hello, am I audible?
Yeah.
Yeah, I just have two questions. Means first one is what's the ROE number of the old established hospital and what's for the new hospitals?
ROE.
Can you
Could you
repeat your
just
question?
repeat that, please?
What is
Yeah,
it?
what's the ROE number for the old hospital which established earlier, and what's the ROE for the new ones which we recently established?
It is not a number that we are separating out and reporting. Our ROE overall as a group, if you would see, we are as of 30th September 2024, we would be around 26.3%. So that's the number that we've reported out. If you split it between India and Cayman, India is slightly on the higher side and Cayman is slightly on the lower side, but still in that range only, mainly because of the capex that has gone online in Cayman. But we've not reported out separately ROE for exists for mature assets and new assets.
Okay.
It may also not be representative to split it out like that, because some of the newer assets are asset light, and the mature assets, some of them are sweated out. So they are at different stages of investment. So it may not really make sense if we split it out like that also.
Okay, and I have just second question, that how many years in which our investments come back entirely from when we done a capex, means suppose we done 100 crore capex and establish a hospital, then in how many years we return back the 100 crores?
See, hospitals are a very long-term investment business. So
Yes,
typically
and
it takes 8 to 10 years, but you must also appreciate that a lot of the investments outside of biomedical, like the big chunk of the investment goes in land and building. So your ability to sweat that asset exists almost perennially. So to that extent, while you may take 8 to 10 years to recover the money, but on an ongoing basis, when you have such investments, they deliver more positive return on investments.
okay, that's it. Thank you.
Yes, Kapil, please go ahead.
Yeah, hi. Thanks for taking my question. My question is on the expenses which are classified under other expenses in the P&L. Now, the quantum of such expenses shown for the preceding quarter and in the quarter of the corresponding year were at similar levels. But for this particular quarter, there is a fairly significant increase. So can you kindly elaborate on the reasons for the same?
I think we would need to understand which line you're specifically looking at. So is it okay with you
Other
if
expenses in your consolidated P&L or your standalone P&L, the item under expenses shown as other expenses. The terminology used is other expenses.
the other expenses, essentially overheads? If I look at the numbers, we are more efficient in terms of our overheads versus last year same quarter. So are you asking what has contributed to that efficiency?
No, let me clarify. What I saw was that the expenses incurred in the preceding quarter of this year as well as the quarter of the prior year are at a similar same level. However, in this particular quarter, there is a fairly significant increase.
23, now it's 26.
So I was just
That's what he's
curious
asking.
what led to that increase.
Can we get back on this to you?
Haji, no problem.
Sure.
Yeah, that's it from my side.
Thanks, Kapil. Vedant, you still have your hand up?
Yeah, so actually, there are certain other things I want to ask. On the insurance platform, what's the guidance regarding the gross written premium growth? And any regions that we're going to expand in the coming years?
Yeah. Ravi, the question is on GWP growth and just a refreshment how we're thinking about the first year.
Yeah. So, I think generally, while we're not giving specific guidance on numbers, some of the things that we're looking at the moment are, which should lead to accelerated growth is building out a lot of our distribution. We're also looking at a set of new products that we'll be launching later on in this financial year. In fact, for this financial year, we expect to be focused on the markets that we're in Karnataka, and look to expand the market as we build momentum and build experience and understand the product market fit. There's a little bit of disturbance from your side, so I hope you're able to hear me.
Yeah, I got you. Thanks, that was helpful. And one last question is that on the Atma platform, that's a SaaS provider. So, what's the growth trajectory that the application is on? Any new hospitals any new healthcare institutions or professionals?
Yeah. So Atma, for those who are not aware, that is our in-house hospital operating system. Our entire hospital runs on that. All our clinics, doctors, labs, radiology, EMR, patient apps, doctor apps, all of that essentially works off of that. We have created a SaaSified version that is available to outside partners, and we've enrolled on a trial basis Ida Scudder Memorial Hospital, which is a spin-off of the CMC Vellore Group. We've partnered with a few non-profit trust hospitals. There is a very large diagnostic chain in Karnataka that uses this. There are a lot of other smaller clinics that take this up, but we've not been aggressive at all in pricing the services. For us, at this point, we're just driving adoption. So the revenue from our external clients is minimal. But what we want to do is to build up a habit and understand what are the modules that they value the most, so we get a better understanding of their utilization. And over time, once we increase adoption, then you can see any significant contribution both from Atma as well as from Meda. Meda is our analytics and AI product, which again is used both internally as well as a lot of other hospital groups are using that. So as a revenue contributor, it's not contributing anything much now. Now we foresee it will be anything significant in the next 2-3 years. For now, we're just looking to really increase adoption and improve the product.
That was a great explanation. Thank you for it.
Thank you. Nidesh, you have your hand up.
Yep. Thanks for the opportunity. Can you share the revenue and the burn in integrated care and insurance business for first half?
Yeah, just give us a second, Nishan.
Yeah, so that number is there in the IR deck. That the EBITDA burn for this NHIC and NHL put together is around 13.5 crores for this quarter. And this number was 11 crores for the first quarter. So collectively for the first H1, first half of the year, we have spent around, EBITDA losses around 25 crores.
And remaining year may not be significantly different from this. For
Okay,
this year.
sure.
As we add to clinics, you can expect a bit more, but the total number should not exceed 55 crores.
Okay, sure. I am a bit new to the company. Can you explain two things? One is that what is the business model in integrated care, and how do you see this scaling up? And secondly, what is the reason for entering Cayman Islands? And do you think do you see further foreign entry in future?
How much time do we have? These are two of my favorite topics. I'll give you the quick summary. See, integrated care, the way we think about it is that the growth of the healthcare business in India is closely tied with the growth of the payment systems. No country in the world you'll see at this level where so many people are paying out of pocket. In our system, 60% pay out of pocket, and even for the best healthcare group in the country, easily half their patients are paying out of pocket. That's simply not the case in most parts of the world where you either have the government or your insurance company paying. Now, with insurance, of course, health insurance industry in India is growing very fast, but is still not growing fast enough as it should because of various reasons. So we wanted to create an alternative product that is sort of like health insurance, but is more in line with bundled healthcare. So bundled healthcare means where you pay us insurance premium and you pay us a care management plan. Both of these together will take care of the entire healthcare needs of your family within our network as well as a narrow network of providers we enroll. And the goal with this is that you pay us and we've screened you. We will keep you healthy. We will keep you out of the hospital. We'll make sure you live a long, productive life. But should anything happen, we will take care of you. No questions asked. No exceptions, no room rent disallowance, none of the issues that normally plague the traditional insurance company, because we have 100% trust and alignment between the hospital and the insurance company. So we created these as two separate entities, NHIC, which will run clinics and care management plans and house a lot of the doctors and clinicians, NHIL, which will be the regulated, IRDA regulated insurance entity, which will sell the policies, do the underwriting, collect the premiums, and disperse to the things in network. Yeah, the question you asked on Cayman, Anesh will answer.
To your question, why we started Cayman, essentially in India, we have a structural cost advantage. So if you look at us versus peers, we realize on a per patient or per transaction basis a phenomenally lesser amount, almost 35-40%. But on a profitability metric, there isn't that much of a difference. So the goal and aim was to see if we could take this structural cost advantage or this more efficient way of operating in India and translate it to a very, very different market where reimbursements are exponentially higher, and see if that would work. So Cayman essentially was an experiment to see if we can take our low cost, high clinical outcome model and export it to another country. We started that about 10.5 years ago. And so far it's been very, very successful.
Sure. Thank you. That's it from my side.
Yes, Santosh, can you please have a question?
Yeah, hi. Am I audible?
Yeah.
Yeah, so I have a question regarding our revenue contribution from a specialty. Are we concentrating on any specific specialty apart from the top three which we have for the next 3 to 4, 5 years, and what is the reasoning behind it?
Yeah, apart from the cardiac sciences and the oncology, I think a lot of focus is going into GI sciences, orthopedics. Nephrourology has been a very strong point in most of our centers. But we are also focusing on the acute care aspect of it. So the ICUs and the emergency cares are some of these areas where we are working on. So we have close to 1,800 beds in the ICUs. So that is one area where we are working significantly on the care of that, as the number of geriatric patients are going up and comorbidities are going up in the country. There is a significant need for things, and that is where we are looking towards.
Okay.
Outside of specialty, we will be looking at investing in the latest modularity for treating patients. So a lot of our hospitals have robotic surgery. Eventually, all our hospitals will have robotic surgery. Similarly, in cancer, we'll be getting into immune therapy and offering that for our patients. So we also want to be at the very advanced edge of what new therapies are available in the market.
Okay, so the greenfield expansion and all this capex is it aligned with this kind of shift which you're looking into, or
Yes.
okay, I
So
understand.
all the capex that we're putting forward are almost adjacent or within a short driving distance of the hospital that we have. There will be tremendous complementarities between the doctors who work in our system and the doctors who work in the other hospital that we run. These hospitals will be built to the absolute cutting edge of spec. The thing about our flagship hospitals is that even though they are the largest revenue contributors, their infrastructure dates back to 25 plus years. And so they are quite dated in their design and their layout and spacing, where the new hospitals will have a very, very different way of thinking about how patients come in and they're organized. We've invested a lot with Atma on digitizing the entire patient journey. So the new hospitals will not have as much waiting rooms, as many registration desks or reception. It will be a fully paperless reception deskless system where with your phone and with kiosk, you're able to navigate yourself through the hospital. Similarly, all the rooms will be able to turn into ICUs, because our focus on intensive care means we want to be able to offer the full modality of care. The rooms will be single and double rooms, and all the operating theaters will have the ability to convert tomorrow into robotic operating theaters. So these facilities we're building going forward in our network, other than the ones that we acquire, but whichever hospital we will build from scratch will be absolutely future-proofed.
And they will also have significant number of daycare beds. So that will take care of the short stay and ambulatory care. So even though you look at the overall bed strength, a significant portion of them will be allocated for the ambulatory and the daycare allocation. Very similar to what the new unit in HCCB is doing in UK.
Okay. My second question is regarding the insurance part. If you see in the presentation, you showed me the payer profile, 29% comes from insured parents and all. So and you also had it when in the call you explained about insurance part where developed countries most of the payment is done through insurance. So and India also we are slowly moving. There is moving toward health insurance. So in next 5 to 10 years, what is the difference we can see in our revenues or the working capital when the percentage of insurance increases in our profile?
Yeah. So definitely cash does wonders for your working capital, but it's also very deleterious to your realization, because people who are paying out of pocket are much more price sensitive. Whereas people that end up paying insurance, while the insurance company will negotiate very hard with the companies on the rack rate and discounts on the rack rate, what ends up happening is that your customers are a lot less price sensitive, and they will opt for private rooms. They will opt for the robotic surgery over the normal surgery. And so one definitely is much better than the other. Given a choice, we definitely want a situation where bulk of our patients are insured, so they're not fully exposed to the actual cost. So the working capital part, yes, it will be stressed, but we're also investing in an insurance company of our own. And so we're hoping that 10 years hence, a large number of patients in our hospital will come from our in-house insurance unit. So it can be netted off.
Okay, understood. Thank you so much.
Yes, Raman, please have your question.
Yeah, hello. Am I audible?
Yeah.
Yeah. Good afternoon. Most of my questions have been answered, but I just wanted to understand more on the current mix of revenue coming in from the out-of-pocket expenses and the ones which are covered by the insurance. So what is the bifurcation of our top line?
Top line.
Yeah.
So how much is cash and how much is insurance? You're asking for payer
Yeah.
mix, is it?
Yeah, payer mixes,
Okay.
yeah.
It is part of our investor deck itself. We report it out. 45% of our patients pay in cash, and about 29% of our patients, I'm talking about India, are insured patients.
Okay, and how do you see these numbers going forward? Like, what has been the industry like?
Industry-wise, insurance is 40 to 45% on average. It will be higher for certain cities like Delhi. If a hospital group is only focused on NCR or only focused on Hyderabad or Bangalore, it will be higher, maybe 50, 55%. But on average, if you do hospital groups that have a mix between tier 2 and tier 1 cities, around 40, 45% insurance patients is about average.
Thank you. That really.
Before we go to the next question, I want to answer that overhead question that was raised earlier. Sorry, I couldn't catch the question properly at that point in time. See, the reason other costs are going up is because the overall number that you are seeing includes the cash burn that we are seeing in the integrated care business. So that a large part of it is bunched in other expenses. If I eliminate the impact of that cash burn, then the absolute overhead costs which are being incurred in the hospital segment has come down only as a percentage of revenue. Though we have seen some stress in terms of fuel and power costs which have gone up across all locations, however, we've been able to offset it through other efficiencies. So as a overhead of the hospital business, we are okay, but some of these cash burns when you're seeing overall numbers, they're getting bunched up in other expenses, and that's why it is looking disproportionate to you.
Rohan, can we get your question?
Hello, thank you for the opportunity. Am I audible?
Yeah.
Yeah, so my first question was largely about the occupancy in the India business as well as the Cayman business for the quarter compared to last year. Thank you.
Occupancies have been good for this quarter as far as India business is concerned. Other than the flagship, the other units have mostly accounted for near 70%, which includes units like Raipur, Raipur, and units like Mysore, Shimoga. When it comes to flagships, the occupancies have been at 64 to 65%. And had not this issue of Bangladesh and the issue which had happened in Calcutta in this last quarter happened, the flagship would have also registered occupancies to the level in which the other hospitals have registered, which is near 70%.
Cayman occupancy was a little muted in Q2 on account of a lot of patients postponing their long stay procedures because of the hurricane and pushing it into much later. Generally, I mean, occupancy is not a number we track to because of the huge amount of focus in Cayman for daycare and a lot of the outpatient services, but Cayman occupancy hovers about 50 to 60% on average.
All right. And my second question was regarding the Cayman facility. So as we see that Q2 is generally a stronger quarter than Q3, and we've seen a decline of 7% in the top line YOY. So how do we see that going ahead in the next few quarters? Are we expecting the same numbers ahead, or are we seeing the businesses going up? Thank you.
Yeah, no, so as I answered, previously the quarter was a little slower than we expected. There were quite a few, small things adding up to lead to a disappointing quarter. But then in the month that's gone by, that's October, the first month of quarter three, we're already back to our previous growth trajectory and a little better as well. So it was, just a a quarter that is likely to be, I mean, that is certainly a one-time occurrence.
All right. Thank you. Thank you.
Yes, Alankar, please go ahead.
Yeah, thank you for the opportunity. Sir, you mentioned that 65 to 70% cost of the Kamana Bay Hospital were incurred in September. Possible to share that number for the full quarter, second quarter?
No, so in the second quarter, we did not, I mean, it would be very difficult, and not sure that would be helpful also, but what would help answer your question is that, so by September, these costs would ramp up. It's not one time, they're ongoing cost. So the cost would be, lesser and lesser in the early months of the quarter, but we estimate about 65% or so were incurred by the end of the quarter. And we're now closer to, early November, we're closer to about 70%, 75% of the costs. And in Q3, you will see by the end of Q3, 100% of the costs having been incurred. Having said that, what I can share is that we are more confident that our measures taken to control the startup costs have been successful. We initially anticipated about 6 to 8 quarters to return to pre-commissioning margins. We now think that will be closer to 4 to 5 quarters, as I had shared earlier as well.
And costs in this case mostly refers to salaries of the manpower we've hired to take care of the new facility.
Yeah, and one big fixed cost for the facility itself. That is just one chunk.
Understood. So actually, that was my second question, because when the hospital is yet to be fully operational, and even the OPD you mentioned has been operational for just a week. So is it just the cost factor which is giving us confidence to advance the timelines?
Yeah, so definitely the revenue ramping up quicker than we anticipate will help, but we don't know if that's going to be quicker than we've anticipated, because it's just been a few days. But looking at the way the costs are shaping up, that did give us the confidence to give a slightly better guidance on that.
Sorry, but the confidence comes from the outpatient footfalls and the expression of interest from patients who are saying that they will come and bring their business to the new place. So that is giving us confidence that it will ramp up much faster, and we won't be bearing this huge fixed cost without any commensurate revenue for as long as we'd initially thought.
Yeah.
Understood. Okay. The second question is, I mean, if you look at the margins for Cayman, now based on our understanding, seem to have reduced by more than 500-600 basis points on a sequential basis in this quarter. Now, possible to broadly break this decline due to higher costs, which you mentioned for the new hospital, as well as on the second side, lower sales in the existing hospital?
Yeah, so I mean, an exact breakup won't be possible, but you can sort of, for example, we're at 29 million for the Q2. The previous quarter was at 32, and the one before was at 30 and a half or so, between 30 and 31. Our margins over there. So that gives you a rough sense of what can be attributed to the revenue decline and what will be on account of the new facility costs. A rough sense that should help.
Fair enough. And two final bookkeeping questions. Broadly, what are our annual corporate overheads today? I mean, what's the current run rate?
About 4% of revenue is what we normally clock in as corporate overheads. But that also includes a significant investment in technology, because we are investing significantly in Atma and Meda. And including that, we do about 4% of revenue.
Understood. And the second one is, what was the contribution from Bangladesh to overall sales before the disruption?
Bangladesh
to overall sales.
Bangladesh typically was around 8 to 9% of revenue. We have come down to 6.5% of revenue.
Prior to pandemic, it used to be 11%. Then it settled down post-pandemic at 9%. Now it's come down to 6-7. But like I indicated earlier, in a decade's time, this number will go down to 0.
Understood. That's it from my side. Thank you.
Thanks, Alankar. Rohan. Yeah, Rohan, you have any questions to ask, or should we move to Devan? Devan, we can have a question, please. Yeah.
So in the integrated business, the realization per transaction has dropped sharply in Q2. almost a 25-30% drop. So any reasons for that?
Ravi?
No particular reason. Part of it is also to do with seasonality and people coming in for kind of lower ticket items is one reason in terms of the transaction.
Okay, got it. And finally, for the next few years, what kind of EBITDA, let's say cash burn rate, do we expect for the NHIC and NHIL business?
Similar burn rate we can assume at least for the next 2 quarters. See, the logic with which NHIC works is cohort by cohort, which means that we start a particular cohort, which is a group of clinics, and that cohort breaks even in about 18 months. In parallel, we move on to the next cohort, which will take another 18 months to break even. So it's a cyclical thing. So we will continue to burn similar amounts of cash in the near future, as we will be adding cohorts.
Okay, got it.
We'll take a question from Prithvi and then I'll go into the chat questions.
Yes. I just have one question, Anik, this is for Cayman business. You have mentioned that 65% of the costs from the new facilities are already part of P&L. So can we assume that for the entire Q2, there is zero revenue, whereas 65% of costs from the new hospital? Is that right?
Prithvi, just to clarify, I said as of now, that is as of the last month of the quarter. So last month of Q2, we estimate that about 60-65% of the costs were online and zero revenue. That is correct.
But for July, August?
It would be a number much less than 60-65%, but it's tough to accurately estimate because there are some fixed costs, some people who are shared between both facilities. We're not maintaining two distinct P&Ls as we've discussed before, because it's a very it's sort of like two campuses of the same facility. A lot of costs are shared between the two, but this is a rough estimate.
So, if that's the case, can we assume the Q2 margins are like bottom, and from next quarter, as revenue scales up, the margins should gradually improve on sequential basis?
No, because in Q3, we will see, for example, all of October, again, zero revenue. November, minimal revenue because of just outpatient facilities being commissioned. If all goes according to plan, December is when we'll start seeing the revenue. But for October, November, we would have incurred, very significant costs, November especially. And December will obviously be 100% of costs.
Oh, correct. Thanks a lot.
So I'll get to the chat questions in sequence. The first question was, is a QIP on the company's mind? Not at this point for two reasons. One is we have sufficient leverage available within the India balance sheet to be able to fund a lot of the expansion what we planned through borrowing, as well as we have sufficient internal cash flows also to take care of a lot of that. We are planning to do a lot more than that post this phase of expansion, which point we would consider. The other reason why the QIP is not something that we're too happy about right now is because we do believe that the value that the market expresses on our company is not reflective of the underlying potential that exists. And it's something that we think maybe we have to do a better job of communicating with the shareholders, and we'll work harder towards achieving that. So for those two reasons, at this point, we think QIP neither raising money at what we believe an unfair valuation, nor the need exists for it to be done right now, but it's something we're open to doing in a year or two time. The next question was asked about sharing current occupancy of India and Cayman, which was asked and we had shared earlier. Question after that on Meda AI, which was incorporated in December, any updates? We had shared that earlier, but I'll give a quick update again. Meda is our AI and analytics division. They run a lot of the programs that we use internally, both for the AI tools that our doctors and our managers use, as well as the dashboards that help us run the finance and supply chain functions. This is also a service that we offer to other hospitals, and quite a few hospitals run our analytics program. And they also are in discussion with a couple more hospitals, but we're not too aggressive on the pricing, as well as on the go-to market strategy is something that we're focused a lot more on product building at this point and having it grow organically. So the revenue impact of this will be muted for the next year or two. The next question was NHIC revenue per patient dropped Q on Q. as the transaction. Right? I mean, Ravi answered that. It's just, seasonality. Anyone who was in Bangalore in this past quarter and had to deal with the rain and the traffic associating from that will understand why no one wants to get out of their house and walk to a clinic. The next question is a pretty long one. Plan on selling the... Okay, so this is a question that is asked about the Atma, which is our hospital operating system. Are we targeting any particular hospital? And some clarity on what the plan is for Atma. So the plan for Atma is, even though we have, at least for this part of the world, the most comprehensive hospital operating platform that includes nearly every module that you require for running a modern hospital, it is still something that we believe has years worth of work left into it, both to make sure it's comprehensive and end-to-end, and two, to achieve our business objectives. The business objectives being able to either eliminate or automate or extremely simplify a lot of the manual, rote, paper-based, Excel file-based system that exists in hospitals throughout the world. Unless we do this, we don't believe we can bring a transformational reduction in the cost of deploying every subsequent hospital that we're looking at. So our headline goal for Atma and Meda is that the hospitals we put up in future should not have a single person working there who is not touching the patient. Now, the things we have to do to achieve that involve a huge amount of digitization and reorganization, and that is the stuff we're working on. But in terms of the value that it currently provides to us is recognized by few hospitals, and they're happy to have the software. It is just not matched entirely by their enthusiasm to pay a lot of money for that software, and we're not pushing them too hard either, because at this point, we just want to drive adoption. There's a question from Vinay about, can a Mumbai-based person get covered under insurance? Not at this point. Our insurance is restricted to Bangalore and Mysore at this time. And the way in which we'll be rolling out our insurance will be rolling it out in all the areas where our network provides a huge amount of coverage. And so in Mumbai, we only have a children's hospital at this point. We are actively looking to get an adult program there as well. When we do, we will set up a large number of clinics, and along with the clinics, we will roll out insurance. But for right now, our priority markets are Bangalore, Mysore, and then eventually we will get into Calcutta and then Delhi. The next question, give the breakup of EBITDA margin between India and Cayman. Sandhya will answer.
So our India margin is, our India hospital margin is there in our investor deck. We've also given the cash burn that we incur in NHIC and NHIL. So the group margin minus the cash burn and the margin that India has made is the Cayman margin. So I think that's something that you can calculate for yourself.
Next question is, does Bangladesh footfalls affect only the Calcutta cluster? Actually, no. So our Bangalore hospital, specifically the cardiac hospital in Bangalore, has a much greater exposure to patients coming from Bangladesh because of the legacy impact of Dr. Shetty's active clinical practice. So Bangalore tends to be a lot more affected by a reduction in Bangladesh footfalls. But as to why the discharge growth has reduced 8%, it's a combination of things, as Venkatesh has said earlier. One is obviously the reduction of people coming from Bangladesh, but also the general movement away from very low payer segments towards those who are much more better placed. So that means you don't end up having a large number of footfalls of low yielding patients. We can focus on fewer higher paying patients taking higher end procedures that are much more viable for running this business. This is a good question that Avinash has asked. What does the management think before establishing a new hospital or any new initiative? The most important thing before establishing a new hospital is, at this point, is it beneficial to the thing that we have? So a new hospital can be there in Bhopal. There are opportunities in Agra, Meerut. There are opportunities all over the place. But if it is not immediately value accretive to the current network, which is not in the vicinity of any of the hospitals we have right now, it gets assigned a relatively lower priority. The highest priority we assign to our flagship centers, Bangalore and Calcutta. Next in priority would be Delhi and Bombay. And then the other hospitals we'll look at in reducing order of priority. What do we think before any new initiative? Again, there are many initiatives that exist in the healthcare industry. There is single specialty hospital, there is all the rage. There are people doing eye care. There is a lot of, there are companies that have spun off their diagnostics their lab business, their radiology, pathology business. There are hospitals that have gone into home care. For that, again, we think what makes sense for the whole. We have retail pharmacies, but we have retail pharmacies only in our retail clinics. We have retail clinics, but we don't have retail clinics all over the country. We have retail clinics that are highly beneficial in terms of getting patients to our main hospitals. Home care is something that is offered as a service bundled with the managed care plans, but is not something that you can independently pursue. Similarly, eye care is something we haven't done because we believe most parts of the country are adequately served with eye care. Other single specialty, we had experimented with dental in the past. We had thought about single specialty, but it's not something we think is something that customers expect from Narayana. I think people come to us for an overall value proposition, someone who's able to offer really high levels of care across the specialties at a very affordable price. So it's not the best fit for us. So in the end, it's generally the strategic intent of how we think about it. Does mental health care feature in your future plans? This is a good question. So mental health is a huge and growing need in the country. It is something that is offered as a service in all our hospitals, but as to whether we can offer it as a spun-off standalone service, we don't believe so. In our NHIC clinic program, as part of the bundled healthcare services that are being offered, we would eventually offer physiotherapy, mental health care, lifestyle coaching, wellness, and those sorts of things. But it wouldn't be something that you would specifically come to a Narayana-run mental health clinic. I don't think we would be very good at that. I think we're good at offering a large bundle of services and not hyper-focused on just one thing. Priyank asked a good question. How do we add new operational beds in the existing hospital network?
शिवानी बोल रही हूँ इन्वेस्टमेंट से आपको एक मेल
Sorry,
भेजा
Shivani,
है
could you mute your... Yeah, okay. Priyank asked a very good question. How do you add new operational beds in the existing network without incurring much capex? Easy. You don't add more beds. You take the bed that you have and do more with it, which is you turn it into a higher yielding bed, or you look at things that can reduce the length of stay or improve the number of discharges. So the adding more bed is the last thing we would absolutely think of. And so if you absolutely have to add a bed, you would try and add it within the same building, either next to an existing bed or on top of the existing building or adjacent to the existing building. Or if you're not able to do that, then you have to buy land and go somewhere else. So O&M models are a way of paying for it. But the problem is you don't always get to choose when you go for an asset light building, how it is built, where it is built. For us, the location and its proximity to our existing hospital matters the most. If we're able to find a hospital that is absolutely synergistic on all fronts, is built the way we want, built where we want, and comes at a price that we want, then we would add that. If not, then we'd have to make the investment ourselves. There's a question about issuing bonus shares. That's a good point. I will sit with the IR team and discuss with them. That is all the questions that I think is there in the chat. If there are any other questions in the call.
Maybe couldn't finish her question earlier. I think she's dropped.
She's done. If there are no other questions.
If there are no other questions, we would like to conclude our session. Thank you everyone for the active participation as usual. Please do feel free to reach out to us in case of any follow-on queries that you may have. Thank you.